Happy New Year, Konnichiwa and Salam Alaikum. UAE markets have steadied and declined slowly during 2010 to date. The DFM is currently sitting at 1688 and the ADX index is sitting at 2679. Volumes have really been thin in the first 2 weeks of January as investors await fourth quarter earnings results from UAE companies and also greater clarity on the credit market developments surrounding Dubai World and other Dubai government related entities that have flowed through from the December market weakness. In corporate news, the UAE Central Bank is looking to introduce tighter regulations on UAE banking system involving a reduction in the time allocated for non-performing loan transactions from 180 days to 90 days and also potentially forcing UAE banks to implement an across-the-board 1% to 2% provision of their total loan book. Based on the current total UAE loan book of 1 trillion, this accounts for an extra 10 to 20 billion dirhams worth of provisions made over the next 12 months, assuming that banks are forced to make up an across-the-board 1 to 2% provision ratio. In the event that the UAE Central Bank implements a policy whereby banks only have to implement the difference between 1 to 2% of provisions and what they've already provisioned for, the impact on earnings will be far less. Despite the possible negative earnings ramifications, the implementation of the central bank policy may be seen as a strong positive indicator for investor sentiment, given that it gives us clarity regarding the state of provisions within the UAE banking system and also the credit profile of UAE banks. It also indicates a strong link between the UAE Central Bank and the risk profile of banks within the UAE. The move also represents another positive step in the evolutionary cycle of the UAE economy, markets and regulation, following on from last year's restructuring and standstill on $26 billion worth of Dubai World debt. This follows on from recent policy regarding bankruptcy, also foreclosure for housing and greater general forced transparency that's likely to play out for UAE companies in order to refinance their debt, giving us more confidence in the numbers of the companies and also the UAE economy and giving better clarity and strength to equity valuations in the process. Within the banking sector, our preferred exposures are still First Gulf Bank and National Bank of Abu Dhabi. In other corporate news, the Saudi to Japan crude oil large tanker route, which is seen as a strong leading indicator for the strength of the bulk liquids and crude oil shipping industry, has actually increased by another 0.5% to 121.8 points, taking the average daily rate for a tanker to ship on this route to over 82,500 US dollars, which is the longest period of successive gains since September 2009. We expect these greater rates to boost earnings during the first quarter 2010 for Gulf Navigation, which has 13 tankers leased out at spot rates to a mixture of crude and bulk liquid clients. Higher average forecast energy prices and a gradual unwinding of the excess supply of shipping assets during 2010 also bode well for Gulf Navigation's earnings profile and investor sentiment looking forward. Air Arabia also announced that it plans to add 2 planes to the new Casablanca, Morocco fleet this year and, if possible, add another 2 to 3 planes per annum to reach a target of between 17 and 20 planes at the base, rivaling the Sharjah UAE hub in terms of number of planes. We believe that Air Arabia has capacity to pay 3 or 4 fils per share of cash dividend during the upcoming reporting season, and also believe that the growth potential of its Moroccan hub is not currently factored into the share price. Thus, we maintain an overweight recommendation and a price target of 1.33 per share versus last price of 92 fils. Telco provider Du plans to spend around 544 million US dollars on capital expenditure during 2010, which is similar to the levels it spent on 2009 as the company continues to roll out its triple play services. CapEx will be funded by a mixture of operating cash flow, reducing its cash balance, and also potentially through raising some short-term debt. DO is also likely to begin sharing its fixed line infrastructure with Etisalat during 2010, which should support profit margins and reduce costs. Earnings per share are forecast to double to 14 fils per share in 2010, underpinning the stock's growth and justifying the high ratio and really looking at its strong growth in market share potential going forward versus Etisalat, particularly in the mobile category. By the Arab Monetary Fund suggests that the gap between imports and exports for Arab nations peaked at around $23 billion in 2008, with the gap set to widen further going forward as UAE and Gulf countries continue to import the bulk of their food due to water shortages, low land utilisation and rising populations domestically. The issue of domestic food security is likely to benefit Agthia, which is the only largest listed food and beverage play in the UAE, producing flour and feed, bottled water and also vegetable and fruit products. Agthia is 55% owned by the Abu Dhabi government and receives subsidies based on the variability of wheat prices into the flour and feed business, and also the government supports the company's strategy by providing more flexibility on planning and design approvals for new distribution centres and new production facilities. Agthia has a low gearing ratio, strong cash flow and trades on a forward PE multiple of 8.3 times earnings with solid medium-term earnings growth potential. Thus we believe that the stock can trade upwards of 2.40 dirhams versus last price of 1.83. In an overall falling market, DP World continues to be a shining light based on its likely improving liquidity following the announcement that this company will seek a dual listing in London. Also based on the forecast pickup in GDP growth during 2010, flowing through to greater trade activity and earnings, and some ongoing cost wins at the margin level, meaning that its operating leverage and profits will increase going forward into 2010. We maintain our overweight recommendation on DP World and believe that over the course of 2010 we can see stock price levels of as high as 65 and 70 cents per share. Despite the market weakness in Arabtech share price following the announcement that it will issue 70% new stock to Abu Dhabi investment company ABAR, we believe that long term the deal is very good for Arabtech as it opens up the Abu Dhabi project pipeline given the links with ABAR, and also allows the company to fund its upcoming working capital and bid for new projects around the GCC and MENA regions. Although there is some risk of receivable write-downs in the short term, we believe that we can take ABAR's due diligence. The price is likely to continue hovering around 2 dirhams 30 in the short term, given that the risk of receivable write-downs during the fourth quarter reporting season is evident with Arabtech. However, long term we still see it as a positive, and we believe that the price will revert towards our target of 3.67 dirhams per share, and thus retain an overweight recommendation. That's all in the UAE markets this week. Happy investing, Alarika, and Sanara!